most people are not aware of it or haven't thought very carefully about it because it doesn't seem to matter to us. This is getting to be so serious that we are reaching a cathartic moment, and I do think it started. Let's just look at the numbers first. M2 growth peaked at 27% in 2020. We believe it is closing in or might be below 3% on a year-over-year basis in September, which doesn't leave a lot of room for growth or inflation unless velocity is really picking up, the rate at which money turns over. And we're in an environment where we do not believe velocity is picking up. If anything, I think individuals and businesses are becoming more concerned and are spending less freely. So if you look at M2 also, you'll see that it actually peaked in March. Now this is very unusual to see sequential declines in money. We have not gotten back above that March peak, and we may not get back above it the way that Fed policy is going. And I think I'd like to build the case a little more here that the Fed is probably making a mistake as we look at history. It was not a 15-year problem, it was a 15-month problem. And from our point of view, it was caused primarily by shocks, major shocks to the system that we had never seen before. We had not had, since Spanish influenza, a global pandemic. And we did not have the supply chain problems, 2 years worth of them, that we had because of the COVID panic. And then, of course, we had another shock to top those off, and that was Russia's invasion of Ukraine. So these are shocks to the system. This was not a period of embedding inflation expectations, and yet Chairman Powell is taking a sledgehammer that is actually bigger, much bigger. We never saw the kind of slowdown in monetary and fiscal policy that we're seeing right now. Federal spending is still down 14% on a year-over-year basis. You never saw a decline in fiscal policy spending in the 70s. Monetary policy seemed to be on automatic pilot back then. The dollar was getting crushed toward the end of the 70s, adding to the inflationary fire. And basically concluding that the Fed right now is much more worried about its own legacy than it is about the economy. It is so afraid that it has let the inflation genie out of the bottle and that it won't be able to get it back, that it is in unison basically going out there and saying, we are going to tighten. We have an unconditional commitment to 2% inflation. Well, I'm going to be sharing with you a lot of indicators that will suggest that using the CPI as its guide, the Fed is making a big mistake. There's already a lot of deflation in the economy. And and one of the reasons the deflation is accelerating here is because the Fed has shocked the system. We have gone from 0.25% in the Fed funds rate to 1.75% in the span of 3 months. That's a 7-fold increase. We've never seen that before. And probably will see lower inflation. So, I think that the administration will take the credit for that. And frankly, all I care about is that inflation unwinds. But to understand the pro-cyclical nature of this policy, taxes will go up. Now, this is over a 10-year period by $737 billion, and spending will go up by $437 billion, thereby reducing the deficit. Now, if that were correct, and I don't think it will be, these numbers are never really correct, but if that were correct, the deficit would be shrinking. And we do know that federal outlays still are down 15% year over year. So that gets into our GDP accounts, and government accounts for 20% of our GDP. So down 15% in 20% of the economy, that is fiscal drag, and is contributing to the recession we believe we're in.